The illusion of rationality and the architecture of belief. We like to tell ourselves a story about money. We think it's a game of pure math. We tell ourselves that if we just learn the right formula, the right algorithm, or the right trading strategy, we can master the financial world. We look at spreadsheets, interest rates, and stock tickers as if they hold the keys to the kingdom. But here is the hard, uncomfortable truth. Money is not a math problem. Money is a psychology problem. It is a game of behavior, ego, fear, and desire. The reason most people fail to build long-term wealth isn't because they aren't smart enough or because they don't have access to the right data. It's because they don't understand their own wiring. Today, we are going to tear down the wall between what you think you know about money and how the world actually works. Think about your own life for a moment. How you view money is entirely dependent on when and where you were born. If you were born in a country or a decade suffering from hyperinflation, your psychological blueprint views stocks as a scam and cash as trash. If you were born in a period of economic expansion, you view investing as a risk-free path to glory. Your personal experiences make up a microscopic fraction of what has actually happened in the world, yet they make up 80% of how you think the world works. This is why financial arguments are often so toxic. Two people can look at the exact same graph, the exact same historical data, and come to two completely different conclusions. They aren't looking at the data, they are looking at their own life stories. To master your finances, you have to acknowledge that your perspective is biased. We also have to talk about the luck and risk factor. In our culture, we love to celebrate the genius entrepreneur. We analyze their books, their diet, and their morning routine. But we almost always ignore the role of luck. On the flip side, we have the concept of risk. You can do everything right. You can work 80 hours a week. You can save. You can invest and still end up with nothing because you hit a tail event, an unforeseen crisis, or a streak of bad luck. When you judge yourself or others, you have to realize that nothing is as good or as bad as it seems. Recognize that luck plays a massive role, and do not be too hard on yourself when things don't go according to plan. This humility is the foundation of long-term success. Finally, in this section, we must address the gap between theory and reality. There is a profound difference between being wealthy and looking rich. Most people get this confused. Being rich is current income. It's the flashy car, the expensive watch, the designer clothes. It's what everyone sees. But wealth is the money you don't see. It's the savings, the investments, the financial runway that gives you the option to say no to a boss you hate or yes to a life you love. Wealth is what you don't spend. It is the active, deliberate suppression of your own ego, the compounding mystery and the trap of enough. Let's talk about the most powerful force in the financial universe, compounding. We understand it in theory. We know that $1 grows to 2, then to 4, then to 8. But our human brains are not wired for exponential growth. We are linear creatures. We think in straight lines. We struggle to visualize the power of the curve. This is why Warren Buffett is often called the greatest investor in history. But the secret isn't just his stock picks. It's time. A vast majority of Buffett's net worth came after his 65th birthday. Think about that. He started when he was a child and he just kept going. Compounding is counterintuitive because it looks slow at first. It looks boring. People give up because they don't see the hockey stick graph immediately. But the magic of compounding is not in the beginning. It is in the endurance. However, getting wealthy is one thing. Staying wealthy is entirely different. It requires a completely different mindset. Getting wealthy requires risk-taking, optimism, and aggression. Staying wealthy requires the opposite. It requires fear, humility, and a bit of paranoia. You have to be paranoid enough to know that everything you have built can be taken away. You have to save for the what if, and you have to build a margin of safety. If you are optimistic, you can grow a portfolio, but if you aren't paranoid, you will eventually lose it all. The greatest investors aren't the ones who make the most money in the boom. They are the ones who survive the bust. Now let's address the most dangerous trap in the game, the moving goalpost. We live in a world where social media has made social comparison constant. You aren't just comparing yourself to your neighbors anymore. You're comparing yourself to the top 1/10 of 1% of the entire planet. This leads to the hedonic treadmill. You get a raise, your lifestyle expenses go up. You buy a better car, you need a better house. You are running as fast as you can, but you are standing still. The hardest financial skill is getting the goalpost to stop moving. You have to define what enough is, and enough is not a number. Enough is a state of mind. It is the realization that just a little bit more is not worth the stress, the sleepless nights, or the loss of your personal freedom. The tails of events and the price of admission. We need to discuss something called the tail event. In investing and in life, the majority of your results will come from a tiny minority of your decisions. You can be wrong 50% of the time, or even 80% of the time, and still be an incredible success, as long as you hit that one big home run that offsets all the losses. This is true for venture capitalists, it's true for stock pickers, and it's true for life. It is okay to be wrong. It is okay to have failures. In fact, you should expect them. The outliers, the big wins, the major opportunities, they are rare. They are tail events. You have to stick around long enough to experience them. If you panic and leave the market after a bad month, you miss the tail event that makes the entire journey worth it. This leads us to the concept of the price of admission. Nothing in life is free. Everything has a price tag, but not every price is written in dollars. Some prices are paid in volatility, in anxiety, in doubt, in fear, and in sleepless nights. People often look at the stock market and see high returns and think, I want that. But they aren't willing to pay the price. The price of market returns is not just money. It is the willingness to sit through a 30% drop without selling. It is the willingness to feel like an idiot when your friends are making money on a speculative bubble while you are sticking to your boring, long-term plan. Most people treat market volatility like a fine, like they did something wrong and need to pay a penalty. But it is not a fine. It is a fee. It is the necessary cost of admission for higher returns. We must also touch upon the paradox of prediction. We are obsessed with forecasting. We want the outlook for next year, the next quarter, the next week. But financial history is a history of surprises. The biggest events in history, the financial crises, the pandemics, the bubbles, none of these were accurately predicted by the experts. The smartest thing you can do is stop trying to predict the future and start preparing for the range of things that could happen. Build a portfolio that can survive a disaster. Build a lifestyle that is flexible. Don't build a precise, rigid plan. Build a resilient plan. Plans are fragile. Flexibility is strong. The ultimate goal and the philosophy of autonomy. As we reach the final stage of this journey, we have to ask the most important question. Why do we actually want money? Be honest. Is it to buy a luxury car? Is it to feel superior to your peers? Or is it to have control over your time? The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. That is the ultimate goal. If you have a high-paying job but you work 80 hours a week and you hate your boss and you have no time for your family, you aren't rich. You are a slave to your income. The reason to save money is to buy freedom. It is to buy the option to change careers, to take a break, to move to a new country, to wait for a better opportunity. When you view money as a tool for autonomy rather than a scoreboard for status, your entire relationship with it changes. I want to leave you with 3 final lessons. First, save money for the sake of saving. You don't need a specific reason. You don't need to be saving for a house or a car. Save because the world is unpredictable, and having cash gives you options. It gives you the power to choose. Second, be reasonable, not rational. Don't try to be a perfectly logical robot. If you need to keep a little bit of money in a fun account to keep yourself from going crazy, do it. If you need to own a specific stock because it makes you feel good to support the company, do it. Being reasonable allows you to stick to your plan for decades. Being hyper-rational often leads to burnout and quitting. And third, protect your time. It is the only asset that you cannot replace. You can make more money, but you cannot make more time. Don't trade your best years for a paycheck that just fuels a lifestyle you don't even enjoy. Money is simply a tool. It is a tool to give you control, to give you peace, and to give you the life you actually want to live. Stop playing the game for the sake of the game. Start playing it for the sake of your freedom. The psychology of money is, at its core, the psychology of living a life on your own terms. Everything else is just detail. The pessimism bias and the intellectual trap. We have covered the basics, the goal of freedom, the importance of saving, and the necessity of endurance. But we must now confront a dangerous psychological force, the pessimism bias. Human beings are wired to pay more attention to bad news than good news. If you say the world is getting better, people call you naive. If you say the world is about to collapse, people call you a serious intellectual. Pessimism sounds like someone who is trying to help you. Optimism often sounds like a sales pitch. In the world of finance, this is a trap. The narrative of decline, that the economy is crashing, that the markets are a bubble, that the system is broken, is seductive because it feels like a warning. But wealth is created by the people who look past the short-term doom. History is a cycle of problems being solved by new innovations. The pessimism bias keeps people on the sidelines, paralyzed by the fear that the next big crash is imminent. To succeed, you must learn to ignore the loudest voices of doom and focus on the quiet reality of progress. The man in the car paradox. Let's dissect the human ego and the man in the car paradox. When you see someone driving a $100,000 sports car, what do you think? Do you think that person is cool? Do you think that person is successful? You probably don't. You don't actually care about the person. You project yourself into the driver's seat. You imagine how you would look, how you would feel, and what people would think of you. The irony is that the driver isn't thinking about you at all. They are thinking about themselves. They bought the car to get the attention they crave, but the people watching them are too busy thinking about themselves to pay any real attention to the driver. This is the endless cycle of status seeking. We buy things to impress people who, in reality, aren't even looking. True financial maturity is the realization that no one is impressed by your possessions as much as you think they are. The world is too self-absorbed to notice your watch, your car, or your clothes. Once you let go of the need to impress others, your wealth and your peace of mind can finally begin to compound. You stop spending money you don't have on things you don't need to impress people who don't care. The value of nothing in the psychology of cash. Most people view cash as a wasted asset. They think it loses value to inflation, so it must be deployed immediately. This is technically true, but psychologically incomplete. Holding cash is not about the math of inflation. It is about the psychology of control. Cash is the only asset that gives you optionality. When you have a cash cushion, you are not desperate. You are not forced to sell your investments at the bottom of a market crash because you need to pay rent. You are not forced to stay in a job you despise because you have no runway. Having a significant amount of cash, or what some call FU money, is a psychological buffer. It allows you to make rational, long-term decisions rather than emotional, short-term survival decisions. Never apologize for holding cash. It is the fuel that allows you to remain in the game when others are forced out. The sunk cost fallacy and the ego of being right. One of the hardest things to do in finance is to admit you were wrong. We fall in love with our investments. We research them, we watch them, and we identify with them. When they start to fail, our ego prevents us from letting go. We hold on to a losing stock because we don't want to admit we made a mistake. We double down, hoping to prove ourselves right. This is the sunk cost fallacy. You believe that because you have already invested time and money, you must stay the course. But the market doesn't care about your past efforts. The market only cares about your future potential. The greatest investors are not the ones who never fail. They are the ones who can cut their losses quickly. They detach their identity from their portfolio. If an idea no longer makes sense, they leave. They don't look back. They treat their capital like a tool, not like a souvenir of their past brilliance. Managing the social contagion of spending. We live in an age of hyperconnectivity. We are constantly exposed to the lifestyles of the top 1%. Instagram, YouTube, and LinkedIn are digital museums of other people's success. It is human nature to mimic the behavior of those around us. If your peers are buying luxury homes, taking expensive vacations, and driving new cars, you will feel an evolutionary urge to do the same. This is lifestyle creep, and it is silent but lethal. The social pressure to keep up is an invisible tax on your future. If you do not consciously curate your environment, if you do not intentionally choose to spend time with people who value freedom over status, you will eventually succumb to the pressure. You have to be comfortable being the person who says, "No, I don't need that," or "No, that isn't for me." You have to redefine what a successful life looks like for you, not for your followers. This is the hardest battle you will fight, the battle against your own social environment. Designing for chaos and the black swan. We talked earlier about not predicting the future, but we must expand on how to handle the inevitable black swan. A black swan event is a rare, unpredictable, high-impact event that changes the world. It could be a pandemic, a geopolitical collapse, or a technological shift. If your strategy relies on everything going exactly as planned, you are building a house of cards. A resilient financial life is built with redundancy. It is built with margin of safety. This means having more insurance than you think you need. It means having less debt than you can technically afford. It means having multiple streams of income so that if one fails, you aren't devastated. Don't bet the farm on your best case scenario. Instead, protect yourself from your worst case scenario. If you can survive the worst, you will naturally thrive when the best happens. The legacy of character. As we conclude this deep dive, understand this. Money is a proxy for something much deeper. It is a proxy for the kind of life you want to lead. Do you want to be a person who is owned by their possessions or a person who owns their time? Do you want to be a person who is reactive to the world or proactive in building your own future? The psychology of money isn't just about stocks, bonds, and real estate. It is about character. It is about the ability to delay gratification, to control your ego, to ignore the noise of the crowd, and to stay the course when everything inside you screams to panic. You have all the information you need. The math is simple. It is the psychology that is complex. Keep your ego in check. Keep your goalposts fixed. Keep your time protected. If you can master these inner games, the outer games, the market, the business, the growth, will take care of themselves. You are the architect of your financial reality. Stop waiting for the perfect market, the perfect tip, or the perfect timing. Start building the mindset that survives, adapts, and wins in any environment. That is true wealth. That is the only strategy that matters. The architecture of temperament, boredom, envy, and the investor's mind. We have explored the mechanics, the ego, and the survival strategies. But there is one final, often overlooked variable that determines who succeeds and who fails: your temperament. You can have the highest IQ in the room, access to the best financial data, and the most sophisticated software. But without the correct temperament, you are a liability to your own portfolio. The financial market is not a classroom. It is a laboratory for your character. The intellect trap. The biggest mistake smart people make with money is believing that their intellect is a competitive advantage. In the stock market, intellect is a commodity. Everyone is smart. Everyone has the same charts. Everyone has access to the same news. What separates the winners from the losers is not the speed of their analysis, but their ability to remain calm when the logic of the market seems to break down. When things get crazy, when the market is crashing, or when a speculative bubble is forming, intellectuals are often the first to rationalize their way into disaster. They create complex theories to justify holding on to a failing asset or to justify buying into a mania. They use their intelligence to lie to themselves. The greatest investors often rely on simple, boring principles that they refuse to violate, regardless of how smart the new, risky opportunity looks. The envy virus. We must talk about the most destructive emotion in finance: envy. Envy is the only game that is impossible to win. There will always be someone who bought the right stock at the right time with more leverage than you and made more money than you. If you base your financial strategy on comparison, you have already lost. Envy creates a copycat behavior. You see someone on the internet getting rich on a speculative asset, and you feel the biological urge to participate. You tell yourself it's research, but it's actually a fear of missing out. This is the antithesis of wealth building. Wealth is built on your own timeline, based on your own needs and your own risk tolerance. When you act out of envy, you are playing someone else's game, with someone else's rules, and you will almost certainly pay the price. The power of boredom. There is a secret about successful investing that nobody tells you. It is profoundly boring. If your investment strategy is exciting, you are probably gambling. Great wealth creation is usually the result of a repetitive, unglamorous, and often monotonous process. It is setting up an automatic transfer, buying a low-cost index fund or a solid asset, and then going to sleep for a decade. If you find yourself constantly checking the price, constantly reading news, and constantly trying to tweak your portfolio, you are not investing. You are performing labor. The goal of financial management should be to get to a point where your money is working harder than you are. If you are bored, you are winning. If you are entertained, your portfolio is likely suffering from overactivity and excessive fees. The circle of competence. Finally, you must ruthlessly define your circle of competence. This is the set of things you actually understand. Most financial failures happen when people wander outside of this circle. They invest in complex derivatives, volatile emerging tech, or foreign markets they know nothing about, simply because they heard a tip or saw an influencer talk about it. The most successful people in the world are not polymaths who know everything about every industry. They are people who know exactly what they are good at, and they stay there. They don't try to be a stock trader, a real estate mogul, a crypto expert, and a business owner all at once. They pick a lane, they master it, and they compound their gains in that specific area. You do not need to know everything. You just need to know what you know and have the discipline to ignore everything else. Wealth is not about being right about everything. It is about being right about a few key things and having the patience to wait for the results to show up. Everything we have discussed, the ego, the fear, the envy, the boredom, is just a test of your temperament. If you can keep your emotions steady, if you can define your own path, and if you can protect your time, you will inevitably find the wealth you are looking for. The market does not care about your intentions. It only rewards your consistency. Stay the course, keep your temperament cool, and let the math of compounding do the heavy lifting for you. The masterpiece, the art of financial sovereignty and architecture. We have traversed the inner landscape of your mind, the fear, the ego, the envy, and the hidden traps that sabotage growth. But now we must transition from the psychology of money to the art of money. Management is not merely about tracking expenses or picking the right assets. It is about the architecture of your financial sovereignty. The ecosystem approach, most people view their finances as a stagnant pool. Money comes in, money goes out, and they hope for a surplus. This is a naive view. You must view your wealth as an ecosystem. An ecosystem is dynamic. It requires constant attention, pruning, and protection. In this art, you are the gardener. Your capital is the water, your investments are the seeds, and your time is the sunlight. If you dump all your water on one spot, you flood the soil. If you starve the plants of light, they wither. The art of management is the art of balance. You must maintain a defensive core that protects you from the droughts of recession, while simultaneously nurturing the aggressive growth assets that allow you to scale. Never treat your financial life as a set-it-and-forget-it project. It is a living, breathing entity that needs your strategic oversight. The architecture of allocation management is, at its core, the science of allocation. We are often paralyzed by the need to find the perfect asset. But the truth is, the specific asset is less important than the system in which it sits. Ask yourself, if my primary income stream evaporated tomorrow, what happens to my ecosystem? If a black swan event wipes out one sector, does the rest of the garden survive? The art of allocation is about building redundancy. It is not just about diversification, it is about decorrelation. You want assets that behave differently under the same conditions? This is the sophisticated high-level management that separates the amateur from the wealth builder. Do not manage for the highest return, manage for the highest probability of survival. If you survive, the returns will eventually find you. The invisible return on investment. We spend our lives optimizing for financial ROI, percentages, growth rates, dividends. But the true artist of money understands the invisible ROI. What is the return on a book you read that changes your perspective? What is the return on a vacation that resets your mental health, allowing you to return to work with double the clarity? What is the return on a piece of technology or tool that saves you 10 hours a week? Management means being willing to spend money on things that enhance your efficiency and peace of mind. If you are constantly exhausted and stressed, you cannot make high-quality financial decisions. Therefore, spending money to protect your time and your sanity is not a waste. It is a capital investment in the machine, which is you, that produces the wealth. The sovereignty of time. As we close, we must return to the concept of sovereignty. Money is not the ultimate end. Money is the battery. It is the fuel. It is the storage mechanism for your life's energy. When you manage your money, you are actually managing your future self. Every dollar you save is a piece of your future freedom. Every dollar you spend on status is a theft from your future autonomy. True wealth is the ability to walk away. It is the ability to negotiate from a position of strength because you do not need the deal, the job, or the approval. The ultimate artist of finance realizes that the goal is not to have a high balance on a screen. The goal is to reach a point where you never have to ask permission. You never have to explain yourself. You never have to compromise your values for a paycheck. You become the sovereign of your own destiny, the long horizon legacy. Finally understand that you are not just managing for the next year or the next market cycle. You are managing for a 15 to 30-year horizon. This shift in perspective changes everything. When you think in terms of decades, the daily noise of the market becomes background static. You stop reacting to headlines. You stop panicking over volatility. You start looking at wealth as a generational legacy. Even if you do not have children, you are building a legacy of competence, of wisdom, and of stability that influences everyone around you. You are now the architect of your own financial reality. The psychology has been analyzed, the traps have been identified, and the strategies have been laid out. The math is simple. The execution is the challenge. Do not wait for the perfect conditions. Do not wait for the market to give you a sign. Start managing today with the discipline of a professional and the patience of a sage. The game of money is hard, but it is fair. It rewards the patient, it punishes the impulsive, and it liberates the sovereign. Go out and build your system, protect your time, master your temperament. That is the art of money. That is the path to true, lasting, and meaningful wealth. Good luck.